Have you ever thought about betting on a company to fail? I mean, not just hoping it doesn't grow, but actively betting that its stock price is going to completely tank. It kind of goes against everything we normally think about investing, right? Which is all about finding the next big success story. Well, welcome to the wild world of short selling, a strategy where people can make a fortune from failure, but where the risks, well, the risks are unlike anything else in finance.
And that brings us to the central, honestly kind of mind-bending question of short selling. See, normally when you buy a stock, your risk is pretty straightforward. You invest $100, the most you can possibly lose is $100. But what if there was a way to lose an infinite amount of money? It's not a trick question. It's the fundamental, terrifying danger of this strategy. And we're about to break down exactly how it's possible. And to really get a feel for the stakes, just look at these two events. I mean, these weren't just gradual climbs, they were financial explosions. Back in 2008, Volkswagen for a brief moment became the most valuable company on the entire planet. And then in 2021, a struggling video game retailer, GameStop of all places, brought some of Wall Street's biggest hedge funds to their knees. Both of these stories were caused by the exact same phenomenon, something called a short squeeze.
So, let's start with the fireworks. Before we dive into the nuts and bolts, let's look at what happens when this high-stakes bet goes catastrophically wrong for the short sellers. This is the ultimate squeeze.
The Volkswagen squeeze was all about one thing: surprise. In 2008, a ton of investors were betting that VW's stock would fall, but then Porsche just dropped a bombshell out of nowhere. Turns out, it had secretly gained control of 74% of Volkswagen's shares. All of a sudden, every single one of those short sellers who had borrowed and sold the stock had to buy it back to return it. The problem? There were practically no shares left to buy on the open market. This created an absolute panic, a frantic scramble that sent the price to the moon.
Fast forward 13 years, and we saw a totally modern version of this story. Only this time, it wasn't one giant company cornering the market. No, it was hundreds of thousands of individual investors, all coordinating on a Reddit forum called Wall Street Bets. They saw that these huge, powerful hedge funds had placed massive bets against GameStop, and they basically decided to fight back. They started buying up shares like crazy, driving the price up and forcing those funds into a brutal squeeze that cost them billions of dollars.
Okay, so we've seen the absolute chaos that a squeeze can cause. But how does this whole thing even start? Well, it all comes down to a really strange concept: selling something you don't actually own. Let's break down how that actually works.
The process sounds complicated, but it really boils down to 5 basic steps. First, you get a special margin account. Then, you find a stock you think is way overvalued, and you borrow shares of it from your broker. Step 3, you immediately sell those borrowed shares at their current high price. Now you wait. You're hoping you were right and the price plummets. If it does, you then buy the same number of shares back, but at the new, lower price. And finally, you return the shares to whoever you borrowed them from. The difference between the high price you sold at and the low price you bought back at, that's your profit. Sounds simple in theory, right? But it's incredibly risky in practice. And this brings us to a super important term: short interest. Basically, it's the total number of shares that have been borrowed and sold but haven't been bought back yet. Think of it as a pessimism meter for a stock. When the short interest is crazy high, it means a huge number of people are all betting on the same negative outcome. And that creates a powder keg, just waiting for a tiny spark of good news to trigger an absolutely explosive short squeeze.
So this gets us to the central debate here. Are short sellers just market predators, profiting from other people's misfortune? Or are they actually essential watchdogs, like financial detectives who expose fraud and keep corporations honest?
There are really 2 passionate sides to this. On one hand, supporters argue that short sellers are a vital check on corporate hype, and sometimes even outright fraud. They do the hard, deep-dive research to find problems that everyone else is missing. But then you've got the critics, who see them as vultures, just profiting from failure. They argue short sellers can sometimes create negative rumors just to drive a stock down for their own gain, and in the process, they could destroy perfectly good companies.
To really understand the vigilante argument, there is no better case study than Wirecard. For years, this company was celebrated as Germany's big tech success story. But a handful of skeptical investors saw that the company's numbers just didn't add up. So they started betting that the whole thing was a house of cards.
The timeline here is just jaw-dropping. Short sellers started raising red flags about their accounting way back in 2015. But in a pretty shocking move, Germany's financial regulator, BaFin, didn't investigate the company. It investigated the short sellers. By February 2019, they had actually banned anyone from shorting Wirecard stock, basically shielding the company from criticism. Of course, it took until 2020 for the truth to finally come out. 1.9 billion euros had just vanished. The company was a massive fraud, and the short sellers, well, they'd been right the entire time.
The whole scandal was so huge that a report to the European Parliament ended with this really powerful recommendation. And this isn't just an opinion, it's a formal acknowledgement that short sellers, whatever you think of them, can be a vital source of information. One that regulators should probably listen to, not try to silence.
Okay, so we've covered the what, the how, and the why. Now let's get a little more practical. How can you actually spot the conditions that might lead to a short squeeze? It really comes down to looking at a couple of key numbers.
The first thing you look at is short interest, which we talked about earlier. Now, in the case of GameStop, it reached this unbelievable level, over 140%. And you might be asking yourself, wait, how is that even possible? How can more shares be shorted than actually exist for the public to trade? Well, it happens when the same share gets borrowed, sold, and then loaned out again and again and again. But the key takeaway is simple. A number this high is a giant, flashing red light. It signals an absurdly crowded bet and a situation that's just deeply unstable.
The second key metric is days to cover, or DTC. Think of it like this. If all the short sellers suddenly panicked and tried to buy back their shares all at once, how many days of normal trading would it take for all of them to get out of their positions? A high DTC is a huge warning sign. It's like being in a crowded movie theater with only one tiny little exit door. If a fire breaks out, you know not everyone is getting out of there easily.
This table gives us a pretty good rule of thumb. A DTC under 2 days? That's pretty normal, low risk. But once you get into that 3 to 7 day range, things start to get interesting and you could see some real volatility. And when you see a DTC of 8 days or more, well, that's the danger zone. It means the short sellers could be trapped, and any little piece of good news for that company could trigger a stampede for that tiny exit door we talked about.
Okay, this brings us to our final and maybe most important point. We've talked about the potential profits and the role shorting plays in the market, but we have to be absolutely crystal clear about the dangers. This is a high-stakes game with unique and really severe risks.
Let's go all the way back to that question from the beginning. How can you lose more than you invested? Well, this right here is the answer. When you buy a stock, the price can only go down to zero, so your loss is capped at what you paid. But when you short a stock, there's absolutely no theoretical limit to how high its price can go. As we saw with Volkswagen and GameStop, a stock can go from $10 to $500 or even $1,000, and that means your potential loss is, quite literally, infinite.
So, to sum it all up, short sellers are staring down 3 core risks. First, that unlimited loss potential we just covered. Second is the dreaded margin call. That's when the stock price is rising against you and your broker calls and demands you deposit more cash immediately. If you can't, they'll just close your position for you, locking in a massive loss. And third, the cost to simply borrow the shares can skyrocket, making it incredibly expensive just to stay in the game.
So, in the end, what is short selling? Is it a vital tool for a healthy market, the kind of watchdog that exposes huge frauds like Wirecard? Or is it just one of the most dangerous bets you can make in finance, a gamble with infinite risk that can blow up in your face like it did with GameStop? You know, the truth is, it's probably both.